There are a ton of different strategies out there in order to make a lot of money with options trading, but there's also strategies out there that are going to lose you a lot more money. So in today's video, I'm going to be giving you 3 option strategies to avoid. Generally, you want to avoid capital intensive strategies, or in other words, strategies that require you to have a lot of cash. And the first one that comes to mind is a cash secure put. So whenever you sell a put option, you're selling a cash secure put, you need enough money to buy 100 shares of the stock at the strike price that you choose. So if this is something like SPY, that's going to cost you nearly $40,000. But obviously, if you're trading something like, I don't know, Coca-Cola, then that's only going to cost you around $3,000 or $5,000. So depending on what stock you're using, this is going to cost you less money. But the problem whenever it comes to a cash secure put is that you're agreeing to buy 100 shares of the stock at the strike price that you choose. And that money that you're putting up as collateral to buy the 100 shares of the stock is locked up until you either close that option or until that option expires. So you're locking up your liquidity that could be used to put on other trades to make you more money in the meantime. And usually with a cash secure put, the reward or the credit that you get isn't all that. Most of the time, you're going to get around a 1% credit up to maybe a 3% credit if you're selling monthly out of the money cash secure put. So the return for a cash secure put isn't that great. Obviously, that would add up over the course of a year. If you continue to annualize that 1 to 3% return, then you would make about 20% per year, which is obviously beating the market, returning around 8 to 10% a year. But the problem is right now we're in a very bad market.
Oh, really?
So you're not going to see the average returns of 8 to 10%. And if you're agreeing to buy 100 shares of the stock that you're selling in cash secure put for, then you risk the stock coming down and having to sell the shares at a lower price than what you bought them for using your cash secure put. And as you're bag holding these shares, that money that is tied up in the 100 shares of the stock, again, can't be used for other trades. So this is drying up your liquidity that could be used in order to put on other trades in order to make higher returns. So for me, I usually make between 4 and 5% per month, but these cash secure puts are only paying between 1 and 3%. So I'm getting about 2 to almost 3 times the return of a cash secure put. And what I do is I mostly trade spread options. So a spread option is when you kind of sell a cash secure put, but then you buy a lower strike price put to reduce the amount of cash that you need for that trade. Now, I've covered this in more detailed videos that you can watch, but it's important to have a lot of liquidity and use as little buying power as you can, especially in this extremely volatile market. And at some point, if you're selling cash secure puts, you're going to get assigned to have to buy 100 shares of a stock. And then, if you're using the wheel strategy, it's time to sell cover calls, which is the next strategy, which I would avoid for right now. So with a cover call, you need to own 100 shares of a stock to put up as collateral in order to sell the call at the strike price that you choose. And whenever you sell this call option, you're agreeing to sell 100 shares of the stock at your strike price. And with the stock market continuing to come down, you're less likely to get assigned to have to sell your 100 shares, which is a good thing, but at the same time, the stock is continuing to decline. So let me give you an example that actually went through during March to June of this year. I ended up starting to buy AMD for around $120 around March of this year, and I stopped buying it around June when it was trading at around $80. So my average price for buying these 100 shares was around $95 a piece. So I bought at $95 and I kept selling cover calls in order to collect these credits. and collect this premium. That way, I could have a little bit of extra income. But I ended up getting assigned at $80. So I bought the 100 shares at $95 to sell them at $80. But luckily, I made enough credit from selling the premiums in order to make up for that. So in the end, I basically broke even for this trade. But if the stock did end up somehow recovering, if we get a Fed pivot or whatever you think the stock market is going to go up on, then you're actually going to be taking on an opportunity cost. So let's say that I sold those 100 shares at that $80 strike price that I had chose for my cover call, but maybe AMD ended up recovering all the way up to $105 a month later. Maybe it went up 25% somehow. In that case, I decided to sell them at $80, but now a month later, AMD would be trading at $105, which means that I could have sold it for a much higher price.
Congratulations, you played yourself.
So that is one of the risks whenever it comes to a cover call. Not only are you using up a lot of liquidity, you're also risking the stock going up, getting assigned to sell your shares at a much lower price than what it could be in the future. And if the stock market continues to come down, which it likely is going to continue to come down, then the stocks that you're buying, most of them at least, are going to come down with the rest of the market. And you're using all of this money in order to hold your 100 shares that could be used in other strategies. So this is very capital intensive. And another capital intensive strategy is leaps options. Now, I've already made a detailed video on why I don't like leaps options, but the gist of it is that the longer that you set your expiration date for any option, the more that you're going to end up paying in order to open that option. So with a leaps option, people usually use 1-year expiration dates, which are going to be a lot more expensive than if you were to buy just a few month expiration date, or a 1-month expiration date, and obviously a 1-week expiration date. For example, right now, a $400 SPY call that's expiring in January of 2024 is currently going for around $4,000, which is a lot of money to me.
You look poor.
My options account is only $10,000, so that will be 40% of my portfolio that I'm putting into a single trade that has a 1-year expiration date. Now, obviously, I don't have to hold that option all the way up until January 2024. I can close out of the option anytime I like, but I'd rather have the opportunity to put that $4,000 into more trades. So spread myself out among maybe 3 or 4 trades rather than putting all of my eggs in one basket with this $4,000 leaps option. So I prefer shorter expiration dates, and you can combat this with long-term debit spreads. So buying that $400 call and then maybe selling a 405 call with the same expiration date, and that's going to reduce the amount of capital, the amount of cash that you need in order to open the trade, which is good. But again, you have a very long time frame for that trade, and there's a lot more money that could be made in the short term, especially with the high volatility that we're experiencing right now. So I'd rather take advantage of the volatility, take on shorter dated expiration dates, and potentially make more money based on the volatility than putting all of $4,000 into a leaps option, drying up my liquidity to where I can't make other trades. Because again, I only have a $10,000 account.
You look broke ass.
Now, maybe if you're a millionaire, or even if you have, say, $40,000, $50,000 to trade options, then if this only takes up maybe 10% of your options trading account, then a $4,000 option might not be a bad idea. But for me, this will be 40% of my account, and it's not worth putting up that much risk and waiting and waiting and waiting for this leaps option to recover as the stock market likely continues to come down. I'd rather put that $4,000 of buying power to better use, take advantage of the volatility, and avoid these capital intensive strategies. So those are the 3 strategies that I would avoid for right now. Thanks for making it all the way to the end of this video. Hopefully it was useful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video, and thanking all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys. Welcome to The Price is Right. My name is Greg, and today we're going to be talking about options trading, where you always get screwed over by the market makers.